Price drops first, but it cannot finish the breakdown. The session forms inside old memory. May 17th Asia session forms slightly wider than April 27th U.S. session box. It overlaps that old U.S. memory. It does not form in open space. It forms inside a place where the market has already fought before. That matters. When a new Asia session forms around an older U.S. box, price does not get clean freedom immediately. It has to deal with old boundaries. It has to test them. It has to hold one side, or fail one side. Until then, the trade is not clear. So the first job is not direction. The first job is location. May 17th Asia starts inside prior U.S. memory. Then, price moves down. It breaks below April 29th U.S. session upper boundary. That is the first loss of support. Then it breaks below April 30th U.S. session upper boundary. That adds pressure. The move looks heavy. The short looks obvious. But obvious moves are often late. Price keeps moving down. It tries to test April 30th U.S. session lower boundary. But the downside does not keep clean distance. The move reaches lower memory. Then the reaction starts. Distance becomes shorter. Continuation starts to slow. The market does not fully accept lower prices. Then price turns up. It breaks back above April 29th U.S. session lower boundary. That is the key change. A line that price lost earlier starts to act like a recovery point. If price reclaims that lower boundary and holds above it, the short loses control. If price returns below it fast, the long is weak. But if price holds there, the long can form. Now price rises toward May 17th Asia session lower boundary. The market is not exploding. It is rebuilding. That difference matters. The long does not come from excitement. It comes from failed downside continuation. Now mark the setup. Long entry line. April 29th U.S. session lower boundary. Stop loss line. April 21st U.S. session upper boundary. Take profit line. April 29th U.S. session upper boundary. Risk-reward ratio 1.85. This is not a large reward setup. That matters immediately. A 1.85 trade can work, but it cannot survive sloppy execution. Late entry weakens the ratio. A wider stop breaks the ratio. A greedy target changes the whole trade. So the entry has to be clean. Why use April 29th U.S. session lower boundary as the long entry? Because that is where price reclaims old memory. After failing to continue down, the market first breaks lower. Then it reaches toward deeper memory. Then it cannot keep pressing. Then it returns above April 29th U.S. lower boundary. That line becomes the decision. If buyers hold it, the long has structure. If buyers lose it again, the long loses its base. You are not buying because price is green. You are buying because sellers fail to keep price below old memory. That is the difference. A green candle can be late. A reclaimed boundary gives a line. Now the stop. Why use April 21st U.S. session upper boundary? Because if price loses April 29th U.S. lower boundary and continues down through older April 21st memory, the long no longer has support. The market would not be rotating back inside the April 29th box. It would be breaking back into lower structure. That damages the long idea. So the stop belongs at April 21st U.S. session upper boundary, not because it feels perfect, not because it gives the prettiest ratio, because that is where the long loses its structural base. Could an aggressive trader place the stop tighter? Yes. A tighter stop can improve the number. It can make the trade look cleaner on paper. It can allow a larger position size. Sometimes price never touches the tight stop. Sometimes that works. But the cost is real. A tight stop can lose the position before the market finishes the rotation. The idea can be right. The position can still be gone. That is why a conservative trader thinks differently. Use a stop that gives the structure enough room. Then reduce size. Do not force a big position when the stop needs to sit deeper. Survival first. Reward second. That is how the account stays alive. Now the target. Why use April 29th U.S. session upper boundary? Because the long entry begins at the lower boundary of that same April 29th box. The first realistic destination is the upper boundary of the box. That completes the rotation. Lower boundary to upper boundary. Old support to old resistance. That is clean. That is measurable. That is enough. Do not turn a 1.85 setup into a fantasy trade. If price reaches April 29th U.S. upper boundary, the trade has done its job. If price stalls there, protect. If price holds above it and builds distance, a new structure can appear later. But the first plan stays simple. Entry at the lower boundary. Stop below the older support logic. Target at the upper boundary. Now think about management. Because the ratio is 1.85, this trade does not give much room for mistakes. If entry is late, the ratio drops. If stop is widened, the trade becomes weaker. If the target is moved higher too early, the trader starts chasing. So management must stay strict. Price must move from April 29th lower boundary toward April 29th upper boundary. If it cannot move away from the entry, the long is not working. If it reaches the midpoint and stalls, the trader must watch reaction speed. If reactions come faster, protect sooner. If pullbacks deepen, the long is weakening. If price keeps holding above the entry and distance keeps growing, the target remains active. This is where traders usually make the mistake. They see the reversal. They believe the bottom is finished. They widen the plan. But the structure only gives April 29th upper boundary as the first clean target. So take what the structure gives. Do not demand more. Now read the full May 17th Asia sequence. May 17th Asia session forms slightly wider than April 27th U.S. session box. It overlaps old memory. Price breaks below April 29th U.S. upper boundary. It breaks below April 30th U.S. upper boundary. It tries to test April 30th U.S. lower boundary. But downside continuation weakens. Price returns. It breaks back above April 29th U.S. lower boundary. Then it tests May 17th Asia lower boundary. That is the recovery. The long entry sits at April 29th U.S. lower boundary. The stop sits at April 21st U.S. upper boundary. The target sits at April 29th U.S. upper boundary. Risk-reward ratio 1.85. The lesson is simple. Do not chase the drop. Wait for sellers to fail. Do not buy the first green candle. Buy the reclaimed boundary, only if it holds. The breakdown starts the pressure. The failed continuation creates the long. Price reaches. It reacts. It holds or fails. Then you execute. Price drops into older support. Then it rotates back to the middle. The session forms around multiple old boxes. May 18th U.S. session forms while holding April 29th U.S. session box. and April 30th U.S. session box together. It absorbs both memories. It does not give a simple clean box. It forms across older structure. That matters. When a U.S. session forms around several prior U.S. boxes, price can move far without becoming clean. The market can test one old boundary, then another, then return to the midpoint. It can look active, but the trade still needs a precise line. Here, the line comes from April 21st U.S. session box. Price first drops. It tests April 21st U.S. session upper boundary. That is the important support test. If price breaks below that line and cannot recover, the long is gone. If price tests it and reacts, the long can form. Price reaches the April 21st upper boundary. It reacts. It moves up. It tests May 18th U.S. session midpoint. Then price turns down again and tests May 18th U.S. session lower boundary. That sequence matters. Lower support. Midpoint reaction. Lower box test. The market is rotating. It is not giving a clean trend. So the trade must be built from the support line and paid at the midpoint, not from hope, not from prediction. Now mark the setup. Long entry line. April 21st U.S. session upper boundary. Stop loss line. April 21st U.S. session lower boundary. Take profit line. May 18th U.S. session midpoint. Risk-reward ratio 2.92. This is much cleaner than the first setup from a ratio perspective, but it still needs discipline. Why use April 21st U.S. session upper boundary as the long entry? Because price drops into that old U.S. memory and tests it directly. That boundary becomes the decision line. If it holds, buyers have a place to defend. If it fails, the market can move deeper inside the April 21st box. So the long belongs at the upper boundary, not after the bounce is already far away. You do not buy the midpoint. You buy the support test. The midpoint is the target. That distinction matters. Many traders enter when price already moves. They buy after the bounce is visible. Then the target is closer. The stop is farther. The ratio gets worse. The trade may still move up, but the execution is poor. Here, the entry must come from April 21st U.S. upper boundary. The support test creates the trade. Now the stop. Why use April 21st U.S. session lower boundary? Because if price loses the upper boundary, but stays inside the April 21st box, the market may still rotate. But for this specific long, the logic is the upper boundary hold. If price falls through the entire April 21st box and reaches the lower boundary, the support hold has failed. The trade is no longer clean. So the stop belongs at April 21st U.S. lower boundary. That stop is structural. It is not random. It is not just under the last wick. It protects the idea. If the April 21st box fails, the long leaves. No debate. Now the target. Why use May 18th U.S. session midpoint? Because May 18th U.S. session is wide enough to contain April 29th and April 30th memories. In a wide overlapping session, the midpoint is important. The midpoint is where rotation often slows. The midpoint is where buyers must prove they can control more than just a bounce. So the first target is the midpoint, not the upper boundary, not a huge trend target, just the middle of the current U.S. structure. That keeps the trade realistic. The ratio is 2.92. That is strong enough if the entry is clean. But the ratio only stays strong when the entry is near the line. If the trader chases after price already moves toward the midpoint, the 2.92 disappears. The same chart becomes a weaker trade. So the rule stays strict. Enter at the line, stop at the structural failure, target at the next memory. Now think about the second movement. After price tests the midpoint, it drops again toward May 18th U.S. session lower boundary. That tells us the market is still rotating. It has not fully accepted above the midpoint. So if the long already reached the midpoint, that profit must be respected. Do not assume continuation. Do not hold the full position just because the bounce looked strong. The midpoint is the target because the market can react there. And it did. That is the proof. Now compare May 17th and May 18th. May 17th gives a 1.85 long. It comes after sellers fail, below April 29th memory. That trade needs clean entry and realistic target. May 18th gives a 2.92 long. It comes from direct support at April 21st U.S. upper boundary. That trade has better space, but it still takes profit at the midpoint because the session is wide and overlapping. Both trades are longs, but they are not the same. One is a recovery back into April 29th memory. The other is a support rotation from April 21st memory to May 18th midpoint. Different location, different stop, different target, different quality. That is how the method works. Not long because price goes up. Not short because price goes down. Every trade must answer three questions. Where does the idea begin? Where does the idea break? Where should the idea pay? For May 18th, the answers are clear. The idea begins at April 21st U.S. upper boundary. The idea breaks at April 21st U.S. lower boundary. The idea pays at May 18th U.S. midpoint. Risk-reward ratio 2.92. Now trader type matters again. An aggressive trader may try a tighter stop. That can increase the ratio. It can increase position size. Sometimes it works. But if the session is wide and contains several old boxes, tight stops become fragile. Normal rotation can touch them. Then the trade still moves to target without the trader. That is the cost. A conservative trader gives more room and reduces size. That feels slower, but it keeps the position alive through normal rotation, especially when the session holds multiple old boxes. Wide overlap needs breathing room. Now trailing. There is no need to force a trail here. The midpoint already explains the trade. If price reaches the midpoint and stalls, protect the trade. If price breaks above the midpoint and holds with distance, a later trail can be considered, but not before the market earns it. A trail should not be automatic. A trail should not come from greed. It only comes after price creates enough distance and after the stop can move without choking the trade. Use at least about 0.5 in risk-reward spacing when building a trail. If the spacing is smaller than that, the trade is reacting to noise. If the stop cannot move beyond entry without becoming too tight, it is often better to take the result. No forced trail. No forced continuation. Now read the full sequence. May 18th U.S. session forms while absorbing April 29th U.S. box and April 30th U.S. box. Price drops to April 21st U.S. upper boundary. That gives the long line. Price rises to May 18th U.S. midpoint. That gives the target. Then price drops to May 18th U.S. lower boundary. That confirms the rotation. The long was valid. The target was realistic. The midpoint was not just a random number. It was the place where price actually reacted. So the trade plan was correct. Entry: April 21st, U.S. upper boundary. Stop: April 21st, U.S. lower boundary. Target: May 18th, U.S. midpoint. Risk-reward ratio: 2.92. The lesson is direct. A wide session does not mean a wide target. An overlapping session does not mean chase. When several memories sit inside one box, the midpoint becomes important. Support gives the entry. The midpoint gives the pay zone. If price reaches, if it reacts, if it holds or fails, then the trade appears.